Your roadmap to the latest in auto. Welcome to Highway Herald. Buckle up, because this isn't just about cars. It's about how a seismic shift in global finance could impact everything from trade to the auto industry. Over the course of just 3 months, between November 2024 and January 2025, foreign governments offloaded nearly $390 billion in U.S. Treasury securities. This unprecedented move comes right as President Donald Trump re-enters the White House and reinstates his hardline America First trade policies. The timing raises serious questions. Is this sell-off a calculated response to Trump's trade agenda, or are we witnessing a deeper shift in the global financial order? Let's dive into the key players and the underlying reasons behind this massive financial shakeup. Number 5. Foreign investment in U.S. debt. Why it matters. For decades, U.S. Treasury securities have been a go-to investment for foreign governments seeking stability and reliable returns. The U.S. dollar's dominance as the world's reserve currency reinforced this trend, with countries like China, Japan, and the U.K. holding large amounts of U.S. debt to stabilize their own currencies and manage trade surpluses. When nations export to the U.S., they accumulate dollars and often invest them in treasuries to earn interest while maintaining currency stability. Holding U.S. debt has also been a strategic tool for building economic and political ties, creating a mutual dependency that influences trade and diplomatic relations. The Treasury International Capital (TIC) report, published monthly, tracks foreign holdings of U.S. securities and reflects global confidence in the American economy. However, the recent $390 billion sell-off signals that confidence is wavering. Countries appear to be reassessing their reliance on U.S. debt due to rising interest rates, trade tensions, and geopolitical uncertainty. This shift could weaken the dollar's standing as the world's reserve currency and increase borrowing costs for the U.S., potentially destabilizing financial markets and global trade. But this shift in strategy isn't isolated. It's part of a broader global trend of financial realignment. Let's take a closer look at the key players driving this sell-off. Number 4. The $390 billion sell-off. Who's cashing out? Between November 2024 and January 2025, foreign governments offloaded approximately $390 billion in U.S. treasuries, one of the largest reductions in foreign-held U.S. debt in history. The biggest sellers included Brazil, $55.9 billion, Ireland, $42 billion, Cayman Islands, $41.2 billion, Canada, $37 billion, Norway, $35.6 billion, and India, $34.9 billion. Even long-standing holders like Japan and China trimmed their positions by $7.8 billion each, while allies like the UK and Singapore also reduced holdings by over $26 billion each. This coordinated sell-off signals a shift in global investment strategy. Rising U.S. interest rates have made older bonds less appealing, encouraging investors to reduce exposure. Geopolitical tensions and uncertainty surrounding U.S. trade policies have further fueled caution, leading countries to diversify their reserves into gold and alternative currencies. The scale and timing of these sell-offs suggest that foreign governments are reassessing the reliability of U.S. debt as a safe haven asset, which could weaken the U.S. dollar's dominance and drive up borrowing costs for the U.S. government. But the sell-off isn't happening in a vacuum. Higher U.S. interest rates are adding even more pressure. Let's examine how rising rates are reshaping global investment patterns. Before we delve deeper, we'd appreciate it if you could subscribe to Highway Herald. Your support fuels our passion to create more content like this. Now let's explore number 3, rising U.S. interest rates, the trigger behind the sell-off. The Federal Reserve has been aggressively raising interest rates to combat inflation, and that's playing a major role in this sell-off. While higher interest rates make new bonds more attractive to investors, they also reduce the value of existing bonds with lower yields. For foreign governments holding large portfolios of U.S. debt, this creates a financial squeeze. They're faced with two options: hold on to lower-yielding bonds and take the loss, or cut their losses and reinvest elsewhere. The result? A surge in Treasury sales as countries try to avoid further value erosion. A stronger U.S. dollar, driven by higher rates, adds another layer of pressure. For countries with weaker currencies, a stronger dollar increases the cost of servicing dollar-denominated debt. That's why many central banks are shifting toward alternative reserves like gold and other currencies to reduce their exposure to the U.S. financial system. But it's not just interest rates driving this shift. Trump's trade policies are adding fuel to the fire. Let's dive into the global backlash. Number 2. Trump's trade strategy and global backlash. President Trump's America First trade strategy, imposing higher tariffs on China, Canada, Mexico, and the European Union, has sparked a wave of retaliation and financial uncertainty. This has made foreign governments cautious about holding U.S. debt, fearing that ongoing trade conflicts could weaken American assets. The European Union has threatened to target politically sensitive U.S. exports like agriculture and automobiles if tariffs go into effect. Meanwhile, China plans to impose steep tariffs on U.S. farm products, including soybeans and corn, which could hit American farmers hard. Chinese state media has hinted that this is part of a broader strategy to reduce reliance on the U.S., with China already shifting reserves from U.S. dollars into gold and other assets. Canada has responded by strengthening internal trade networks and preparing countermeasures targeting up to $125 billion in U.S. exports. Unlike previous trade wars, foreign governments aren't just responding with tariffs. They're offloading U.S. debt and diversifying reserves into alternative currencies. This coordinated response suggests that Trump's trade policies are driving a long-term shift in global financial strategy and weakening confidence in the U.S. as a stable economic partner. But what does this mean for the long-term stability of the U.S. economy? Let's assess the broader consequences. Number 1. Long-term impact on the U.S. economy. The $390 billion sell-off of U.S. Treasuries reflects deeper concerns about America's fiscal health. The U.S. national debt exceeded $35 trillion in early 2025, driven by increased government spending, tax cuts, and higher defense budgets under Trump's administration. Federal Reserve Chairman Jerome Powell has warned that rising debt levels and higher interest rates could weaken the U.S. economy by increasing debt servicing costs, leaving less funding for public services and infrastructure. Reduced foreign demand for U.S. debt could push bond yields higher, making borrowing more expensive for both the government and private sector. This could lead to higher mortgage rates, costlier business loans, and slower economic growth. The sell-off also signals a move toward de-dollarization, a shift away from the U.S. dollar as the dominant global currency. Countries like Russia, China, and India are increasing gold reserves and diversifying into other currencies like the euro and the yuan. Industries heavily reliant on global supply chains, such as automotive and agriculture, are particularly vulnerable. Higher tariffs on imported components could add $1,500 to $3,000 to the price of a new car, hurting demand and causing job cuts. Retaliatory tariffs on farm products could reduce exports, drive down prices, and strain American farmers. The verdict: a turning point for U.S. economic influence. The $390 billion sell-off of U.S. Treasuries isn't just a financial adjustment, it's a clear signal of declining confidence in the U.S. economy. Trump's protectionist trade policies and rising interest rates have pushed even America's closest allies like Japan, Canada, and China to reduce exposure to U.S. debt and shift reserves into gold and other currencies. If Trump escalates tariffs, the impact could be severe: higher inflation, reduced export competitiveness, and rising costs in industries like automotive and agriculture. The key question is whether the U.S. will adjust its trade and fiscal policies to restore confidence or face a future where the dollar loses its dominance. What do you think? Is Trump's trade strategy helping or hurting the U.S. economy? Should the U.S. revise its fiscal policies to regain global trust? How would a weaker dollar affect American industries? Could global markets shift away from the U.S. dollar? Share your thoughts in the comments. If you found this video insightful, be sure to subscribe to Highway Herald for the latest vehicle updates and in-depth analyses. Thanks for watching and see you next time. You can now check out any of the videos on the screen. There's more exciting and informative content waiting for you.